Now, what happens is we are discussing about the mechanics of future market. Okay, and in last class we also discussed about the future contract. Understood that the future contract we can go for a long and short position in future contract. So long means you buy first and sell later on. Short means you sell first and then buy later on. Now we understood that the future contract is used for three purposes: arbitraging or arbitrage, hedging, and then speculative purposes, speculative trading. Understood about open interest and all in the last class. Now, normally in a future contract, we have certain things mentioned already. So future contracts are standardized forms of contract. So in last one also we discussed about that the underlying asset is there in a contract, price is there, and the initial margin, the expiry date, and the delivery date are there. Now there are some terminologies related to future contracts like quality of underlying asset. Now the quality of underlying asset in shares are all same, but in commodities obviously different kind of quality may have different kind of future contracts, commodity future. Now delivery time is obviously written there, delivery location is given there if it is a commodity one. Contract size we understood, the lot size, the minimum number of shares we can buy in one future contract. And daily price limit is like it is we call price freeze also. So trading freeze or price freeze or trading limit. So daily price limit is basically uh, as a percentage you can say as could be let's say 4% or 2% or 6% kind of that, which is set by exchange. So if the price limit is hit for the day, there will be no more trading on the exchange in that particular contract. So let's suppose that we have Tesla Motors. Okay, so we have Tesla Motors, and we understand that the price is let's say $100 for one share, and the upper limit is 4%. So that means after 104, if the price increases 4% in a day, so once this limit is hit, there will be no trading. So trading is freezed for certain time. Let's say maybe 15 minutes or half an hour. And then after relaxation of 15 minutes or half an hour, they allow trading again. And there is another circuit limit, let's say 2%. So if the again it hits, let's say 1 in 6 kind of thing, so the trading is again halted for the entire day. So likewise, this is an upper circuit limit. So upper price limit you can say. And let's say price goes down. So let's say 4%, let's say 96. So there could be a lower price limit. Okay. So these are upper circuit limits. After this, if the price hits in one single trading day, there won't be trading anymore. Or quite possible exchange can halt trading for 15 minutes and then they resume the trading again. Now, in this kind of situation, there is another circuit limit. So after the second circuit limit or daily price limit is hit, they stop the trading for the entire day. Then there's a position limit. Position limit means the number of contracts one person can buy in one day. So let's say quite possible exchange can give you a position limit. Let's say no one can buy more than 70 contracts in a day. Okay, kind of that. So 70 contract means let's say if one contract has 1,000 shares and you're allowed to buy 70 contracts, so that means 70,000 shares you can buy in a day, not more than that. So position limit is basically you cannot buy more than this number of shares. Now price quotation and tick size. Price quotation we understand it is written there. Okay, let's say if we talk about copper price. So let's say copper price is quoted as 400 per kg, and quite possible the lot size or the contract size could be 1 metric ton. So that means around 1,000 kg. Okay, so price quotation is given there in the contract, and tick size is basically the minimum price change. Minimum price change means, let's say if the price is 100 and you want to buy at, let's say, 99.95, so you can buy. So if the tick size is 5 paisa or 5 cents, let's say, so that means minimum price change would be at least 5 cents, or let's say if INR is 5 paisa if it is an Indian market. So it could be like 99.90 or 99 point, 85, but it will not move like 99.84, 83. So minimum price change. Hold on a second, I got a call. Hello. Give me a moment, I'll be back in a couple of seconds. Yes, I'm back. So as I was telling that the tick size is basically the minimum price change. Okay. So if price goes up or price goes down, it will go. If the tick size is 5 paisa, it will minimum change by 5 paisa. Okay. Now convergence is a spot and future price. Now what do you mean by convergence? Now normally there is a difference between a spot price and future price. So the future contract price can be greater than the spot, or future contract price can be smaller than the spot. So there will be a difference between a spot and forward price. So this difference is we call either spread, we call it spread, or we call it basis. Okay. So near maturity, basis converges to zero. So what do we understand this thing? Let's say in the beginning on 1st January, the prices of spot is 100 and the price of future is 104. There is a basis of 4, dollars, and quite possible that the on 31st January, which is the expiry or the maturity of the contract, the price of a spot goes to, let's say, 110, and the future will also go to 110. So there will be no difference. Let's say here the difference is 4, which is the basis. Here will be 0 basis. Now why there is a 0 basis? So the spot and the future meet at the time of expiry, and there's no basis. There's no spread. Why? Because see, the basis is most of the time because of the interest, the cost of carry. We'll understand the future pricing in couple of hours from here. And so this is because of the interest. So you have 30 days till expiry. So for 30 days, let's say charging $4 as an interest. Whereas on 30th January, that is the expiry date, there will be no interest. So the spread is almost zero. Now, convergence through arbitrage example, I'll take this thing later on. Convergence through arbitrage example when we will discuss the future pricing formula. Now, margin trading. We understood this thing in last class, that when we buy shares, we normally pay the initial margin. Okay, and leverage we understood in the last class. I'll repeat that again. Now, what is leverage? We understood in the previous class that let's suppose we are buying 50,000 kgs potato and we are paying 5,000 for that as initial margin. So we are enjoying 10 times as a leverage. So this is basically the credit. So which means the total value divided by the initial margin required to get into the contract. So this is leverage. And what is initial margin? Initial margin is the basic amount token which you pay for the good faith in the beginning of the contract. So this is the cash outflow from both the side, the buyer and the seller. Both deposit with the exchange. Okay. Now maintenance margin. Now what is maintenance margin? Normally, let's suppose the exchange says that you have to maintain a margin of let's say 80% of the initial margin. So which means, let's say the initial margin is 10% of the total value. So initial margin you take of the total value. Now let's take example. Suppose the lot size is 500 shares and the price is 1000 per share. So the total value will be around 500,000. So let's say initial margin is, let's suppose 10%. So the if you multiply all this, we get the initial margin of, let's say not like this into this into 10%. So we get around this much as the initial margin. Now, so 10% is the initial margin. Now there is something called maintenance margin. Now maintenance margin is what? Let's suppose if I say the maintenance margin is 80%. 80% means around, you can say 80% of this initial margin. So which means that is around 8%. So the maintenance margin is, let's say 80%. So 80% of what? 10%. So you can say the initial margin. So that gets to the maintenance margin, which is 8% here in this case. Now, so which means if you have a loss of 2%, you may get a margin call. Okay, so that is what is your maintenance margin level. Now, if it is given in terms of percentage, okay, if it is given in terms of percentage, then you simply calculate the percentage value. And if it is given absolute figure, that 200, let's say you deposit 500 as initial margin and $300 is the maintenance margin. So if you have a loss of $200, you get a margin call at 300. Okay, so that's how you calculate it. Okay, now let's take a numerical example about the maintenance and variation margin. I'll give you. Let's say take a percentage wise example, or we can take a absolute value also. Hold on a second, I got a call. So from this margin trading example, we would be able to understand uh, the concept of initial margin, the maintenance margin, and the variation margin. So normally I have told you already that the initial margin can be given in terms of percentage or can be given as an absolute figure. So let's take this example. Let's return to our investors with the long gold contract. The investor enters the position at $993.60. So the investors take a position, okay, at $993.60, and each contract controls 100 troy ounce of a current market value of around $99,360. So that means they are taking around 10% of the total value as the initial margin. Okay, so the total value of the contract is $99,360, out of which to buy a contract you need to pay around $993. So the lot is of around 100 troy ounce. Assume that the initial margin is $250. I'm so sorry. The price was around 993 and for one tri ounce, and the total value is for that is 990, 3.6400, tri ounce. And to buy one future contract, the investor has to pay around $2,500. Okay, and the maintenance margin is $2,000, which means if he has a loss of $500 or more, okay, he will get a margin call. So his account balance should be $2,000. And if the future price drops to 991 at the, so it says that the future price drops to 991 at the end of first day and 985 on the end of the second day, compute the amount in initial amount in the margin account at the each day for the long position and any variation margin needed. So in nutshell, we will say that the price of the position, the price of the gold was around $993 for an ounce. Okay, and the contract has a lot size of around 100 tri ounce. The total value is 99,060, and for this thing we have to pay, to buy one contract I have to pay $2,050, and the maintenance margin level is $2,000. So maintenance margin is the level where you get a margin call. So you get a call from brokers to deposit the variation margin, which means whatever is your loss, you have to bring it back to the initial margin level, top up level. Okay, so it is telling you compute the amount in the margin account. So how much margin is left in the margin account at the each trading day. So we understand that in future contract we have daily marking to market settlement. So normally profit is credited into your account and losses taken back from your margin, the initial margin you have deposited. And if the initial margin falls below the maintenance margin, you get a margin call. So here is the solution. At the end of the first day, the loss is from 993.60 it went to 991. So the loss is around 2.6, and the lot size is 100. So total loss is 260. Okay. So when the account is marked to market at the end of day, 260 is withdrawn from your initial margin. Okay, so your initial margin was $250, so $2,500. So I minus $260 from that account, and you have a margin left that is 2,240 in your account. Now, the margin account balance of the short position is now how much? 2,760. So what happens is when you buy, you pay 2,500. And the same contract is sold by somebody. So there is a buyer who buys as 2,500. He pays the initial margin as a security deposit. And there is a seller at the same time who also puts the 2,500 as a security deposit. So that is the initial margin both gives to the stock exchange. Now, if there is a profit, now profit means if the price increases, the buyer of the contract is benefited, and if the price is reduced, the seller of the contract is benefited. Now here what happens is the price actually dropped. See, it dropped to 991. So there was a loss of around $2.6 on per ounce of gold. So there was 100 tri ounce. So there was a tri ounce. So there was a loss of $260. To whom? To the buyer. And that is reduced from the margin given by the buyer. So in his account there is $2,240 left. Whereas in the account of seller, it is being credited, the profits being credited. So his margin balance increases. So it goes to 2,760. Now at the end of second day there is another marking to market done. So every day is marking to market. So the price is, let's say on the next it goes to 985. So from 991, now you have to calculate it from 991. So till 991 you have done the settlement. So from the next last previous day's settlement price you have today's settlement. So previous day's settlement price was 991 and today is 985. So you again have a loss of $6. So you have 100, lot size. So $600 was a loss. So in that situation, if we reduce 600 from 2240, we are left with 1640. Now 1640 is below the maintenance margin level of $2000. Now in that situation, what happens is, what in that situation you get a margin call. So because your balance is below the maintenance margin level. Okay, so at 1640 the investor will get a margin call since the margin account balance is less than the maintenance margin, and the variation margin is the amount necessary to bring the margin account back to the initial margin. So how much you need it back, to bring it back to 2500? So 2500 is the initial margin level. So the difference between the position, the account position, current your margin balance, and the required initial margin, we have to figure out that. So the required maintenance margin, the required initial margin is 2500, and the balance in your account is 1640. So you have to bring $860, okay, from your bank to your trading account to carry on the position. So if you are not interested in depositing the variation margin, so your position will be squared off and $1640 will be credited in your account. Okay, back. So basically you get a margin call and the broker asks you that, dear, you are short of $860 in your account because you need to maintain 2500 and your balance is 1640, so you bring in $860. If you bring in, then your position will be carried on, and if you don't bring in, then will score off your position and remaining balance 1640 will be given back to you. So you understand the concept of maintenance margin and variation margin, and the initial margin is the amount to get into a contract, to buy one contract. Fine. Now let's move on to next concept. Now clearinghouse. What a clearinghouse does? Basically, clearinghouse is an intermediary between future contract transactions. So the buyer and the seller both deposits the initial margin with the clearinghouses. So the broker maintains the margin account with the clearinghouse or the clearing member, and clearing member maintains the margin account, and they basically helps in settling the account. So if the buyer has loss, so the losses will be debited from his account and credited into the account of the seller, because seller is making profit. Price goes down, seller makes profit. So the clearing house basically do the settlement work. Now settlement price is similar to the close price at whatever is the market closes. So an average of the price of the trades during the last closing period is set by the exchange. So normally sometimes it happens that the average price of the trades during the last closing period is little bit different, okay, than the settlement price. Why? Because there are dividends which are coming in on the same date, or quite possible there may be some other cash flows. So because of that there is adjusted close price. So due to adjusted close price, they make the average price of the trade or the during the last closing period. Okay, and they declare it. So exchange declares that the average price of the trade or the adjusted average price. Now it is used to make margin calculation at the end of trading day. So this is the price at which the settlement is done. So you call it adjusted close price also. the average price of the trade during the last closing period. And the initial settlement price over time indicates a normal market, and conversely the decreasing settlement price over the time indicates an inverted market. So basically, if the settlement price is increasing over the time, so it is going from 100 to 101, 102, 103, it's a normal market, or we can say a bullish market. And conversely, if the prices are decreasing, with the time, so from 99, 98, 96, it's an inverted market, or you can say a bearish market. Over the counter market. Over the counter market, we understand when we trade one to one without interruption of an exchange. So there is credit risk or a default risk, and there is no as such clearing house in between, okay, during the OTC market transactions, because the transaction between you and me, then there is no third party required, or the clearing house is required. Now, delivery process. So one can terminate the future contract in 4 different ways. What are the ways? Basically, delivery. Delivery means a short can terminate a short position. That means I have taken a short position, so I have sold the contract right now. So let's say if you sell the contract right now, so you can terminate the contract by delivering the goods. So let's say I promise to sell shares, and there is another guy who wants to buy share. So they both get into a future contract. Delivery will be 30 days later on. So in that situation, what happens is, uh, the seller, if he's having those shares in his demat account, so he can mark the delivery. Okay, so the long will accept the delivery and pay the full amount, the full value of the shares of the underlying asset. So let's say in last example we just took an example that the lot size is 500 and the price is 1000, so total value is 5 lakh. So the buyer will pay the 5 lakh or 500,000 to the seller and accept the 500 shares. Okay, so the delivery is only possible, okay, when the seller has the assets, the underlying asset in physical format with him, or in demat format in demat account. Now, another type of settlement we have discussed is cash settlement, where the prices, the future contract is mark to market based on the settlement price on a daily basis, and there is no delivery done. So if the price increases, profit is credited, price decreases, the loss is debited. Now, reversing or closing a trade. So reversing and closing means if you are into a buy position, you sell the contract and close the position. Okay, so that is a reversing a trade. So you buy a position, you sell it, you close the contract, or you have already sold, you buy the same contract and you close the position. So that is reversing a closed trade. Okay, so delivery is you deliver the underlying asset, cash settlement is daily marking to market settlement, and reversing a closing trade, that means you are basically buy position, you take sell, and if you're sell, you take buy and close the trade. And settling through physical exchange in an ex-bit transaction. So basically taking delivery from the exchange. So instead, if you are a seller, you can deliver, and if you have a buyer, you can take the delivery. Okay, so this is what is delivery process. Now there are two types of order broadly, you can say, or in fact 3-4 types are given here. One is your market order or discretely market order, another one is limit order. Market order means you are putting the order at the market price, which means that the future contract current market price or the last traded price LTP is, let's say, 100, and you are ready to buy at this market price. So whatever is the best offer price in the market, just get it that. So this is market order. And limit order is like, let the current market price is 100, but I want to buy, in case of limit order, let's say I want to buy at 98. Now in this situation, this price quotation will be, submitted to the exchange, and it will be in pending orders, or you can see orders in queue. So we can use both the terminology, pending orders or order in queue. So I put 98 as my price. Now in that situation, there will be no immediate buying of the share. If the share price decreases, if the share price decreases to 98, then your order will get triggered and it will get executed. So this is what is when the price reduces. But if the price does not reduce, your order will automatically get cancelled. So how long your order stays into the system, that depends on the validity instruction. Okay, so validity instructions you can say is validity instructions. So validity instruction is like you are with time limit, which is like there are broadly 3-4 types like IOC, good till date or good for the day, GFD, and good till week or good till date. So there are many. So broadly we can say as GFD, that is good for the day. So your order, the price will stay into the server, okay, or the exchange for 1 day. So if during the entire day price falls from 100 to 98, your order gets executed. Otherwise, your order will get cancelled. And the validity, let's say good till date, GTD. So good till date means you give a date, let's say 28th of January. So till 28th of January, my order or my price will be there into the exchange. If from today till 28th of January the price falls and it comes to 98, my order gets executed and shares will be transferred into my demat account. Then we have GTC, that is good till cancelled. Good till cancelled means this order will remain into the system forever. So if let's say even after 6 month price come down to 98, then execute my trade. Okay, and it will be never out of system until unless I cancel it myself. So that is GTC. So that is forever. If it comes today, tomorrow, or day after that, or maybe after a month, it will get executed. If it never comes, it will never get executed, and order will remain in the system. It will never get vanished. Okay, so it will never get cancelled until I cancel it myself. So that is validity instruction. So you have market order and limit order. Market order means buy at whatever price is available. Limit order means I give my limit order, and limit order depends on the validity instruction. Could be good for the day, good till date, GTC. Okay, or IOC, that is immediate or cancelled IOC. So IOC stands for immediate or cancel. That means I press my order of 98. If it gets immediately executed, then okay. Otherwise, cancel the order. So we call it fill or kill order also. Fill or kill order. So 1 second में trigger होना है, नहीं होना तो cancel. Now stop loss orders. ठीक है. So what is a stop loss order? Basically, stop loss order is placed with a trigger price. Let's understand stop loss order. Let's suppose price is coming down and it went up. So price, let's suppose, came down to $100. Okay, and I decide to buy at this price. Now what happens is, if the price goes up, I make money. It goes to 105, 110, anything. And if the price comes down, I make losses. So in case of profit, obviously I will exit after 4-5% to 3%. What is my expected rate of return? And if it comes down, obviously I'll stop my loss after point. So let's suppose my stop loss level is 98. So if the price falls down to 98, then close my position automatically. So I don't have to put a 98 sell order. Okay, automatically it will execute. So I'll buy at $100. Now the shares get transferred into a demat account, and after that I want to place a sell order that the price if falls to 98, then execute and close my position with a loss of $2. And if price goes up, let it go up. So what I do is I place a stop loss order. So what I do is I put a sell order with a limit price. Okay, so limit price of 98. Now there is a problem. What? If I place a sell order at 98, current market price is 100 or more than 100, and if I sell at 98, the sell will immediately trigger. So it will actually immediately happen. Why? Because all other people are selling at $100 and I'm putting a sell order at $98. That means it's cheaper than the market price. So it will immediately get executed. Now I don't want that. I want that if the price goes down to 98, then you place a sell order. And if it does not go down, then don't place an order, just keep it. Okay, so don't execute it, just keep it. So normally if you place a normal sell order, you have a buy order and you have a sell order. So if you want to sell, you place a sell order. If you want to buy, you place a buy order. Buy you have already taken at 100, and if you sell at 98, it will immediately execute because you're selling at the lower than the market price. Now you want to sell only if the price comes down to 98. Now in that situation, I'll put a trigger price. Now trigger price is like, you can say you can put at 98 or you can put at 99. So you put a trigger price at 98 itself. So if the market touches, the price touches to 98, then place my order of selling the shares at 98. Otherwise, if it doesn't touches, the price doesn't touches to 98, then my order will not get placed into the system, and let the price go up and you make the profit. So what I do is I put an instruction of selling at 98 with a trigger price of 98, or I can put a trigger price of, let's say, 97, and then I can place an order. If the market goes to 97, then place my order of 98 price selling, and it gets executed, then your loss will be 2. Otherwise it will into a pending order. So if you don't put a trigger price, it will immediately get executed. I'll show you an example how we do it. So any of you guys have traded before? You can use the chat box to answer me. Have you traded before? Anybody? Yes. Great. How about you, Gargi? Have you traded before? No? Yes? You can use the chat box. You know how to use the chat box? You have a chat box on the terminal. Let's take example, a live example of let's say how do we take a stop loss order. So I get into one of my trading account. So my broker is Sher Khan. It's okay, it's good. You can open with anybody, there are many. Yes, I have Zerodha account also. I have account with India Infoline. I have account with Angel Broking. And I have account with Testimony Securities. Many, many others. But I'm not an active trader. I'm a passive trader and I have these accounts to teach students. So I most of the time trade in holdings and sometimes in options. I love options trading, but not frequently. Now let's load a list of Nifty 50 companies. And let's suppose I have to place in stop loss order. Or how do I do that? So before I place a stop loss order, now currently the market is closed. I'm just giving you how example how you do it. So you open it, buy script, and you put the quantity when you want to buy the quantity you want to buy. So let's say I want to buy 5 Asian Paint shares. Okay, series is equity. This represents the shares you want to buy on National Stock Exchange (NSE), and you want to buy these shares. So 5 shares. Now, what is the price? If I put 0 here, that by default will take market price. So what is the market price currently? It is around 879. So let's suppose it is running market and the price is 879.25. Okay. So it will buy near to this. Okay. So can be offer price, you have to see here, whatever the seller's price, the trade gets executed immediately. So if you want the delivery immediately, or you can say you want to buy the shares immediately, you can place the market price. And the product type is investment and big trade. Normally we have intraday trading and we have investments, and then the validity instructions. Oh, now, so in the product type is investment, and validity is basically GFD. Because the price is 0, I place the order and it will immediately get executed. And if I want to give a limit price that I want to buy at 870 and the market price is 879, so, and if I place the order, obviously currently the market is closed, it will not execute. It is showing me an error, the market is closed. No worries. So if I want to buy at the limit price of I'm sorry, I've selected Axis Bank, that's Asian Mint. So I want to select the quantity 5 and I want my limit price. So I put here 870 and I place the order. The order gets placed into the system, but it will never get executed immediately. So it will get executed when the price comes down to 870 from 879. So 9 rupees down, it will give you a tweet. So you will have the shares. Otherwise, no. So how long your shares, the order remains into the system, that depends on you, on the validity instruction. Good for the day, my good till date, I specify the date here, or immediate or cancel. Okay, it could be good till week. So different softwares, different brokers give you different validity instructions. Okay, and you place the order, you get the shares. Now once you get the share, let's say you buy share at the market price 879 immediately. Once you get the share, now you want to book the profit. So what you do? So you place a sell script. So you sell a script at, let's say, 900 and you place the order. So now the system, the order will again hit the exchange server. And would you be able to sell at 900 immediately? No. Why? Because the price you're selling is higher than the current market price. So this order will remain into the system based on the validity instruction you give. And when price increases to 900, your orders get executed and you book the profit. So this is about the taking booking profit. Okay. And hold on for a second. Fine. So this is what about the booking the profit. Now what about, let's say I want to exit the market if price hits to let's say 860. So I want to put a stop loss at 860. So I want to sell the shares at 860 if price falls. So if I decide to sell the share if the price falls to 860, then exit with a loss of 19. Okay, it's 879. So I'll have a loss of around 19.25. So I exit. But what happens if I place this order right now? What will happen? It will immediately get triggered. Why? Because you are selling cheaper than the market price. So you're selling cheaper than the market price, obviously a buyer will buy. So you're selling costlier than the market price, higher than the market price. In that situation, if market price reaches to 900, then your price gets executed. But if you put a cheaper price, then in that situation, the market executes it immediately. So stop this thing. I will be placing a trigger price, let's say 861. So when the market reaches 861, then place my order of 860 into the system. So till then, just keep a trigger price there and keep a watch. If the market hits the trigger price, then execute my, then place my order at 860, and at that time it will get executed. So this will be executed at around 860. You won't have any loss. Okay, so you can keep it 860 also. So this is a stop loss order. Now then we have bracket orders also. Now, what is a bracket order? Bracket orders are very simple orders. What you do is, let's say you want to buy the shares at 879, and it's pretty simple, easier to handle. You want to buy 100 quantities. What you do is you put the book profit trigger price. So that means I want to sell at 900 and I put a stop loss price, let's say 860, and place the order. So it will automatically put the upper and lower circuit limits, lower limits or upper limits. The price it's 900, it get executed. The price goes, stop loss. If price goes 860, it gets executed, and you are buying at 879. So your upper and lower your bracket, okay, so that you book profit or you book loss. And let's say you don't want to put the bracket order like this, and you want to put simply the limit loss to. So I want to limit the loss to 9 rupees. So I keep it 9 and place the order. In that situation, it will take, if you are buying at 879, when the price comes to 870, it will execute. Otherwise, no. So putting the loss limit, amount of loss. No. So that is what is your validity instructions and all. Fine. And then we have a stop limit order. A stop limit order with your limit price, and the stop loss orders with market price. Market if touch order is like if the price goes to that limit, then you only execute my orders, like a stop loss order only. But for buying also you can put, if market touches to 900, then buy. No. Which of the following is not a characteristic specified in a future contract? Normally, let's take some of the questions. And which of the following is not a characteristic specified in a future contract? Tell me. Delivery time, it is there into the future contract. Asset quality is there in the future contract if it is a commodity contract. Asset quantity is there, and collateral detail is no as such called collateral. Okay, so D will be the answer. Now a trader holds a long position in a commodity future contract, and with the following characteristic: the initial margin is $1,000, the maintenance margin is $250, the Contract price is $250, and each contract includes 100 units. Okay, fine. So the initial margin is $1,000 which you have to pay, and the maintenance margin is 250. So when the price falls down to 270, sorry 750, more than a loss of 750, then you get a maintenance margin call. Now, so it says that if the price drops to 2495 on the end of the first day and 2492 at the end of second day, which of the following is correlates to the variation margin required at the end of second day? So first day we have a loss of around $5, and we have 100 units. So the total loss is $500. So from initial margin, $500 is gone. So $500 is left into your account. Okay. So at this stage, hold on for a second. So at this stage, we have a loss of $5. Lot size is 100 units, so $500 is loss, and your initial balance was $1,000. So $1,000 minus $500, so $500 left in your account. Huh? Initial margin is $1,000, and at the end of first and the second day, 2492 is the price, so $3 more loss you had, so that means $300 more gone, so $200 is left into your account. So which would be your variation margin? So you need to have $1,000 and you have $200 remaining, so $800 is required. So the $800 is your variation margin. Now, which of the following order may never be executed except market order? It will be executed. Limit order, may never be get executed. Stop loss order may never be get executed. Immediate or cancel may never be get executed. But market order will get executed at any cost because you are buying at the market price. So it says may never be get executed. So this will always get executed. So which of the following is false regarding a forward contract? It is already traded. Obviously it is false. That's a forward contract. No, it is true. I thought future contracts may include collateral. No, it is fully standardized. Forward contract is not a standardized contract. It may include collateral. It can be used for hedging activity. Yes, it is used for hedging activity. It may include collateral, and it is traded over the counter. So a forward contract is not a standardized contract. Futures are standardized. A future trader is concerned about credit risk of a particular future contract. Will the process of collateralization protect him? Now, collateral is posted and the losses are guaranteed by exchange, thus he will be protected. Collateral is held by the exchange and losses are covered by the collateral at conclusion of the contract term, thus he is protected. There is no collateral process in the OTC market, thus he is not protected. A future trader is concerned about credit risk on a particular future contract. Default risk on a future contract. Why? Will the process of collateral happen? There is no collateral process in the OTC market, thus he is not protected. So OTC मार्केट में कोलेटराइजेशन नहीं होती है, तो OTC मार्केट में तो नहीं होगा क्योंकि दोनों पार्टी सिक्योरिटीज नहीं देती है. Collateralization basically both the parties deposit the initial margin. Now there's a marking to market feature and losses are settled in cash daily, thus he will be protected. So will the process of collateralization protects him? Now we have a doubt here, so we'll take a doubt. Please tell me.
Hi, my question is, here they say futures trader. So futures is not over the counter, right? So why are we saying over the counter market? I mean, because futures are traded over the exchange, right?
Yeah, futures are traded over the exchange. So there is no collateralization process in the OTC market. That's why In OTC market, he is not protected.
Oh, okay.
Okay, so OTC market, no forward contracts are protected with credit risk. Whereas the future market, both party deposits the initial margin, which is kept as a collateral with the exchange. And if one makes profit, the initial margin is credited or debited from the winners or losers account.
Okay.
As I'm switching off the mic. Now, so what happens is, it says the will the process of collateralization protects him obviously. So there's a marking to market feature and losses are settled in daily cash limit. So that's why he will be protected. B is also true. D is also true. And collateral is posted and losses are guaranteed by the exchange. Thus he will be protected. So A is true. So D is wrong. C is wrong. Sorry. Now, initial margin deposits for future accounts are set by the Federal Reserve US market. I don't think so. Typically 50% of the purchase price, usually larger for the short position based on the price volatility. So the initial margin of the deposit of future contracts. So how these are determined basically. So normally the initial margin, it depends on the standard deviation or the volatility. So there is value at risk VAR model we use it, that is made from the volatility itself. So based on the price volatility, the stock exchange decides, okay, not the Fed Reserve. Fed Reserve is basically controlling the monetary policies. Okay, so they don't decide the future margin, or there is no hard and fast rule that there is 50% will be fixed, and usually larger for the short position. It's not like they both are equal for the buyers and sellers in future market. So based on the price volatility, the exchange decides the daily, initial margin of the contract. Initial margins are not also fixed forever. Now if the standard deviation increases, the volatility increases, the initial margin is also increased. The volatility is very less, the initial margin also, the required initial margin also very less. Now all of the following are methods to close out a future position except. So what are the methods? Delivery of the underlying commodity, we can close out. Engaging in an offset trade in the future market, we can close out. Through an exchange for physical with another trade, close out. Allow the contract to expire without taking action. Now, this is not a way to close out. We cannot allow the contract to expire without taking action. If this is not a method to close out the future contract, this is what something you leave the contract and the exchange settles the contract. Okay, so D. A similarity of margin account for both equities and future is that for both, interest is charged on the margin loan balance. Yes. If the initial margin effectively paid to the seller of the security by the buyer, initial margin is effectively paid to the seller of the securities by the buyer. Is it so? I don't think so. Additional payment is required if margin falls below the margin level. Yeah, this is true. So the value of security is collateral for the loan. The value of security is collateral for the. Now this can be done. So you can put the security as a collateral, okay, for the margin, and you can take margin against that one. So this is not the case here. The initial margin is actually paid to the exchange, not the seller of the security. Okay, so both the party deposit it to the stock exchange or the clearing member set by the stock exchange or the broker. Okay, and this is not given by the buyer to seller in future contract. Okay, and interest is obviously charged on the margin loan balance. So the amount of credit you take, leverage you take, and the initial payment is required, additional payment. If margin falls below the maintenance margin, you pay the variation margin. And the value of security is the collateral for loan. So basically, if you want to take the margin loan, okay, for the future contract. So let's say the total value of future contract is 5 lakh and you are paying initial margin of 50,000. So around 4.5 lakh you are taking as a margin loan. So on this thing, the interest is being charged by the broker. That is very minimal. And if you want to take the margin not from cash, you want to get the margin from your security, you can put the security as a collateral and you get the margin loan. So if you have stocks in your demat account, you can take the margin against those stocks to trade into the future contract. So let's say I used to do it. Let's say I have 4 lakh worth security or 400,000 worth security stocks into my account. I take the margin of 80%, let's say almost 3.2 lakh, or kind as a margin, almost 80%, and I do trading with this into future contract. So this is also quite possible. Now let's move on to another aim statement: determination of future and forward prices. Okay, so before I start, let's take a 10 minutes break, and I'll be back after that. So let's have a stretch break, and I'll come back in 10 minutes. Okay. So how future prices, future contract prices determined, we will understand in this topic. Now, broadly, there are three kinds of, you can say, there are two kinds of assets: investment assets and consumption assets. So like shares, bonds, indexes, these are investments assets, and the consumption assets are like copper, nickel, iron ore, chana dal, tur dal, turmeric, spices, and all. So these are you know consumption assets. Okay. Gold comes under investment asset. Okay. And for investment assets, we can use arbitrage concept to determine forward and future price. So I'll give you the example. Now, what is short selling? We understand that we sell the contract first and then buy when the price goes down and close the contract. So here what happens is the short seller borrows stock from the broker in order to sell them, and subsequently he purchases stock from market to return to the broker, which is called covering the short position. So what he does is he first sell the stock. For that he doesn't need to hold the stock in advance. So if you don't have shares, no worries, you simply sell them, and the credit is provided by the broker. Okay, and when the price goes down, you buy and close the position. Okay, and that is covering the short sell position. It's very simple. The investors keep the margin account with the broker, obviously, and he deposits the initial margin into the account, which is locked basically, and once the position is closed, it is returned back to you. So all short seller pays all dividend to the lender of the securities. Obviously, the broker is basically the lender here for the securities, and the broker is not in fact owning the stocks. Basically, what happens when you are trading online? Uh, there is a broker in between, and you are the client. Same wise, the broker has many clients, and the broker has a settlement with the stock exchange, and there are many brokers. Okay, so what happens is all these guys have account with the brokers. So let's say you want to short sell. So okay, this is somebody who wants to short sell, and this is somebody who's having the underlying asset. So what happens is he is settling with the broker and broker is settling with the exchange. Now what happens is broker is having the underlying assets as a stock with them, inventory, as inventory with them. So what they do is they lend these securities for short selling to C, and this guy. So basically in his name, nothing else. The shares are kept with the broker only, and the short seller can sell the securities, and when the price goes down, it can cover the position by buying the securities, and the difference will be profit or loss. Let's say it goes down, you cover, then it is your profit. So let's say you sell it at 1000 and price goes to 900 and you cover the position by buying, so you're closing and you're making a profit of 100. Now during this period, you are not owning the short seller is not owning these stocks. So the stocks are owned by the original broker, okay, or the client, another client. So whoever is owning the stock, okay, that time will get the dividend, okay, not the short seller. So short seller also provide collateral to guarantee the repurchase. Okay, so he keeps the margin into with the broker, and if there is a loss, the loss is deducted from the short seller's collateral, basically the margin. Okay, so there is no as such default risk. And when the contract is open and the broker runs out of share to borrow, let's understand this concept. It's very important, and it's a risk also while short selling. So when, let's say, the contract is open means, let's suppose I have sold on 1st January and I have borrowed from broker. So on 1st January I sold, okay, on 1st January I have already sold, and actually I am borrowing from the broker. Let's suppose the broker runs out of the share to borrow and the investors is forced to cover the position. This is called short squeeze. Now what happens is, 1st January have sold from borrowed from the broker. Now broker is maintaining the inventory. Let's say somehow the delivery is made by other clients. Other clients too have the shares with the broker, and they give the delivery instruction that we want to close the position by delivery. Now somebody who has already sold it, and there are many others who are selling, and the quantity is less there. Okay, or let's say the buyer asks for the delivery, his own shares. In that situation, there is lesser inventory with the broker or lesser number of shares left with the broker. So brokers basically run out of shares to borrow. Okay, and then that is called short squeeze. In that situation, the investors is asked, the short seller is asked that to close his position, okay, at whatever profit or loss he is gaining, and settle the contract. So this happens normally, um, in short selling of the shares, sometimes, but not always. Now what is the difference between forward and future? Forward contracts are non-standardized and futures are standardized. Forwards are over the counter and futures are exchange traded. Forwards are have default risk or the counterparty risk. Futures doesn't have it. And the forward have a specific delivery date. So you can say that that on the date of delivery only this will be settled. And futures have normally 1 month future, 2nd month future, 3rd month future, 6th month future, kind of that set by the exchange. Now here the settlement in the forward contract is done only on the maturity. So let's say I do a forward contract for the delivery of potato. So potato will be only settled on the delivery, or the physical settlement will be only done on the date of maturity. So you want to go for a cash settlement or a delivery based settlement or anything else, that will be done on the maturity of the contract. Whereas in the future contract, it is daily marking to market settled. Okay, so profit is given, loss is taken from the margin account. Okay, and forward could be delivery or cash settled, and future can be also delivery and cash settled, but futures are most of the time cash settled, and prior to the maturity itself, most of the guys settle it. So they take the cash as a profit or loss. So there are very less people who take the delivery of the future contract. Now, forward pricing formula, how the forward contracts or the future contracts are being priced. Hold on for a second. Give me a second. I'll back. Now, so while doing the forward pricing, okay, uh, we normally take some assumptions. Now, assumptions are like same tax rate are on all net profits. Borrowing and lending are at the risk-free rate of interest, which is normally 91 days treasury bill or the government bonds interest rate. And the arbitrage opportunities are exploited as they arise. So that means the future contracts are priced fairly or theoretically, and no transaction cost. That means there is no brokerage or anything like that, and there are no short sell restrictions. So that means you can freely short sell the contract. So these are the assumptions taken uh, before we get the future contract price. So when we arrive to a future contract price, the forward contract price, we normally, do not account for transaction cost or short sale restrictions or like that. And if we follow these assumptions, we take these assumptions, then the formula comes to the forward price or the future price equals to the spot into exponential raised to the power rate of interest into the time. So this gives you the formula. Now I'll tell you one thing. This thing is something wrong with the curriculum. I don't know the books they have made the PPTs from, because I have referred to one or two books. Couple of places they have written this thing uh, as wrongly interpreted, I can say. Normally, as per my knowledge, the forward pricing is the forward contracts are settled on the date of expiry, and there is no daily compounding done. So if there is no daily or continuous compounding, the forward pricing formula should be very simple: spot into 1 plus rate of interest to the power, you know time. Very simple. So the compounding we use. So the rate of interest, and we compound it, keep on compounding it. Okay, so because the delivery is done on the date of expiry. So let's say if delivery is after a month, let's say, or after an year, we put the rate of interest for the year, or that is divided by 12 and we get multiplied the month. So kind of that. So if it is monthly compounded, and because the future contracts are daily settled, so for future contracts this formula holds true. So I don't know how they have written forward pricing and the formula for future contract. So let's consider this as a formula for future contract, because future contracts are daily settled. Or if we want to consider forward pricing, then just consider for this topic forward and futures are priced the same way. So the formula as per the curriculum, hold on for a second. See, you're understanding what I'm trying to say is, because the forward contracts are settled on the date of expiry, on the maturity, and there's no daily settlement. So you don't have to calculate the continuous compounding. You don't have to do the continuous compounding to determine the forward price. So you have to do the simple 1 month future forward contract. So you get the 1 month contract price, and if it is 1 year, so you have to simply the 1 year, and you don't need to put a compounding event also, because you have to settle it on the date of expiry itself. So compounding is only done when you have, can be a multiple settlement dates, or you can offset the contract. Now, why do we do a daily compounding? Is that because the contract is being daily settled. So profit and losses, gain or loss is credited or debited into your account. So that's why we do a daily compounding. So if we lose 1 day, so 1 day interest is deducted from the price. So if, let's say, longer the maturity, the higher the contract price would be. So let's say a contract which is priced something on 1st January, and it gonna expire on 30th of January. So the interest period will be for 30 days. And we're buying the same contract on 10th January and the expiry on 30th January, then 20 days interest will be charged. And you are buying on 25th January, then 5 days interest will be charged. So kind of that. So you have lesser interest charged because that is settled daily, whereas the forward contract is settled on a monthly basis or a yearly basis. So there is no daily compounding needed. But I will recommend you, if the question is like this, the calculate the forward or future pricing, you can use the same formula as given in the curriculum. Don't go by my explanation. I think this should be futures pricing at the top heading. I don't know. Anyways, the formula for the forward pricing or the future pricing is this thing. So the future price equals to spot into exponential raised to the power r into t. So F refers to future price. Now, so let's take a simple example. Uh, Suppose that the S naught stands for spot price and the E stands for the exponential value, which is by default 2.718, and the rate of interest is the risk-free rate, normally on 91 days treasury bill in your country. Okay, see, whatever stock exchange you are trading in, let's say you're trading in on let's say NYSE, then you have to look for the Fed Reserve's 91 days treasury bill, or a short period treasury bill, maybe on government bond, which is for 2-3 months, but normally government bonds are not for 2-3 months. So 91 treasury bill, 91 days treasury will be good enough to take. So here in India it is around 7.5 or 8%, I don't remember. So let's consider it as 8%, and then the time remaining till expiry. So if it is 1st January and expiry is on 28, so 28 days, and let's say it is 20 January and expiry is on 28, so 8 days remaining, so you take it 8. So if you're doing it on 1st January, so let's say this is, and 28 days remaining, so 28 days will be the time. So if you put this thing into formula, so you get the value. So let's suppose the spot price is 1000. You simply multiply it by the exponential value 2.718 and raise to the power your interest rate, that is 8%, into 365 days. Remember, you don't take 360, you take 360 normally in bond pricing or interest rates, and remaining divided by 365 and multiply 2. So this is what you get the value of the theoretical value of the future contract. Okay, sometimes the futures are overpriced or mispriced. In that situation, the arbitrage opportunities can be exploited. Okay, so you can do the arbitrage and you can make some money. I'll give you an example of that. So this is a very simple formula. So you put the spot, exponential value, and percentage of interest, risk-free rate, and time remaining. You get the value for the forward contract or the future contract. Now, if let's suppose during the period, if income or dividend uh, will come on the share in the same month, then in that situation what we do is we reduce the dividend from the spot price. So this I stands for dividend. Okay, so I stands for dividend. So if you know the dividend's absolute value, 10 rupees, 5 rupees, $1, $10, you reduce that from spot and you get the value for future contract. And if the income dividend on the stock during the period is known in terms of percentage, then what you do is you simply reduce that percentage dividend from rate of interest and you get the future contract value. Okay, now it also says that if, now what is K and E? I have to check that with the notes. Hold on for a second. Do we have K written here? So we have dividends minus K. So this is continuous yield, I guess. If you're getting some continuous yield, then that will be minus. So if there is a continuous yield. Yes. Okay, give me a couple of minutes. Let me refer to the notes because this is continuous yield, I suppose. Because if we get continuous yield from a forward contract which is more than the dividend, then we reduce it and the forward contracts become backwardation instead of contango, what is more. So this might be continuous yield. Let me check, give me a couple of seconds. So we're understanding the cash and carry model, and the spot price of Reliance future, spot price of Reliance shares is 1050 on 1st of August. And we can see that on 5th August it has increased and then again increased, reduced and reduced. So there is volatile during the month. Now we know the exponential value is by default is fixed 2.718, interest rate is fixed, but yes, time left till expiry is reducing. So on 1st August there were 30 days left in expiry, and on 30th August the expiry left was 0 day. Now, so the theoretical value if we calculate based on the forward pricing model, if suppose there is no dividend given during the month, so the price would be like spot into exponential to the power r into t divided by 365 days. So 30 days was remaining, so I get a value of 1056 for the future contract. Now this is the theoretical value, and the basis or the spread is 1050 and 1056. So if we subtract it, we get 6.93, which is the basis between spot and future price. Okay, now so if we see on 5th August the 5 days passes, after that the price increased, the theoretical value increased, but the basis reduces, the spread reduces. So as the contract reaches the expiry, there is less day remaining, so interest charge is very less. So on date of expiry 30 years, there is no days left, so there will be no interest for 0 day. So theoretically the spot price and the future contract price should be same, and the spread, the basis must become 0. Okay, or we can say the spot price should converge to the future, or the future price converge to the spot. So the spread should be zero. So you understood in the slides, previous slides. So because of no interest charge. Now, but this is just the theoretical portion. Now, if I'm trading on stock exchange and the current market price on 1st August I see is 1070. Okay, so I see the current market price which is 1070. Now, so the spread between, or the basis between spot and the actual price of future contract on the stock exchange is 20. Now, so when it is 20, the spread should be 6.93, which means it is overly priced. So it is overpriced. But yes, doesn't matter on 1st of August, it is overpriced. On the date of expiry, both should converge and has to be same. If it is not same, then the date of expiry people can do arbitrage. Let's suppose the actual future contract price is higher than the spot on 30th August. Let's say it is 1150. Then what will you do? You simply deliver. So you buy in the spot, take delivery and deliver it to the exchange. Mark the delivery. You make 20 profit. And if it is late, sorry, if it is low, then in that situation, you will take the delivery and you sell it on the stock exchange. So because of this, normally the futures contracts are fairly priced on the date of expiry. The spread is very less or it's equal to zero. So keeping this in mind, we can do an arbitrage. What we can do is we can buy Reliance shares in the spot. You can do it yourself also. If you see gaps more than 1-2%, if you see the gap spread. So let's suppose you buy the Reliance shares in the spot on 1st August. That was priced at 1050. And on the same day on 1st August, you sell the Reliance future contract on stock exchange. So which was 1070. So theoretical price is 1010, 1056, but actual it was trading at 1070. It was mispriced. So I'm selling the mispriced future contract of 1070 on 1st August. Now on 30th August, I know that the both price will be same. So I close the contract. So I sell Reliance share in a spot at 1000, 11 and 30 because I have bought, I'll sell to close my position. So when you buy, you have to sell. So at 11:30 you sell. So you make a profit of 80. Whereas you sold the contract at 1070, the Reliance contract you sold, the Reliance future contract you sold at 1070, the price increased to 1130. So you are losing around 60 rupees into this. So you sold first, you will buy, it's a short sell position, price increase, so you are losing 70 here, 60 here, sorry. So the net is your 20. So this 20 becomes your profit. So this is what you get. So what happens is if there is a spread, you can encash that. You can get into your pocket. If it is overpriced, it is good to do. If it is fairly priced, if you short it, you get this 6.93 into your pocket at the time of expiry. That would be hardly, point something percent, 0.8% or 0.7%. Why? Because you are charging an interest rate of 8% over this time. 8% interest you can get simply into fixed deposit. So you don't need to do so much headache. So it's simple. You put into fixed deposit, you get 8% an year. So point something a month. So if it is priced more than the theoretical value, then you should take the cash and carry arbitrage. If you see the another aspect here, let's say I don't have the money, or if I want to deduct the opportunity cost of 6% or 8% or 6% of this thing. So reduce that, minus 6 here. Let's say you take a loan from somebody at risk-free interest rate for a month, and you have to pay him 6-7 rupees. So even if you reduce the 6-7 here, then 13 is your net profit after deducting the loan interest on loan. So that 13 will be your net profit. So this is how people do it. People do it. Previous people used to do it manually. There were no, softwares. Nowadays, you have many arbitrage softwares in the market. I have worked on, let's say, Omnisys. They're good. Geeksoft. What they do is they have the live data feed coming from the stock exchange, and they keep on, scanning the market, and you feed the strategy, and whenever they see the spread or the basis on, let's say, if you're feeding this strategy, cash and carry, and they will pop up this stock, and if you want to take the position manually, and if you want to program it for an algo, that means they will take an automatic trade themselves. The machine will buy and sell, so machine will do the buying and selling part automatically, so you don't have to do anything. You have to feed the strategy and just watch profit popping up, nothing else you have to do. But yes, in today's date, arbitrage is getting tougher because everybody has the machines set up near the stock exchange, so it's really difficult to get money from mispricing. So market are coming very close to the fair price. So mispricings are less in future contract at least. Yes, options they may have, because options are very much dynamic, and pricing is based on Black-Scholes model, and Black-Scholes model itself has too many assumptions. So in options you still have arbitrage opportunities. Anyways, so hopefully you understood this thing. So you're taking hedging a position in the beginning, and you are closing both the position at the end, and you're getting the benefit. Now let's move on to the hedging strategies using future contract. Now we understand one thing: we have two positions in the market, short hedge and long hedge. Okay, so a short hedge means you are hedging through short, and long hedge is you are shorting through a long position. You're hedging through a long position. So if you want to hedge your long position, you do a short hedge, and if you want to hedge your short position, you go for a long hedge. Okay, so that means you have already taken a long position. You can take short and you go into a hedge, that is called short hedge. And if you're already short, and you can buy the contract and you can go into a long hedge. Okay, so the position you take is your hedge. So if you're selling and your previous position was buy, so it's a short hedge. But that has to be done in two different contracts. So the hedging can be done into two different contracts. You can say is two different assets. So let's say you have spot, you are buying in spot, and you are selling 1 month future, 1 month future. So you're selling a 2 month future, you're selling. So that becomes a hedge. So that is a spot and future hedge. Another one is you have 1 month you have buy into future contract. So 1 month contract you are buying in future month, future contract. So you have multiple month future contract. So you are selling second month future contract. Okay, so you are selling second month future contract. In that situation, we have a buy and a sell. So that is again a hedge position. Okay, so both you can do, and this is future to future. And then you have hedging through options also. You'll understand. So future to future hedging is possible, and spot to future is hedging is possible. And then there are cross hedging also, hedging through indexes. Okay, so we'll understand the short and long hedge, uh, and the advantages and disadvantages and all. Let's take a numerical example of long and short hedge, how this thing can help us save money and save our risk. Let's say give you an example. मेरे मौसा जी हैं, उनका नाम है सोहन लाल. ठीक है, तो सोहन लाल जी ने he bought, let's say, turmeric. I don't remember the rate of turmeric and all. So he is basically a turmeric trader. This guy bought, let's say, turmeric for 1,000 rupees per kg, let's suppose, and let's suppose 1,000 kgs or 10,000 kgs. So I don't consider for the lot size. So lot size you multiply at the end to get the net profit. So he is buying turmeric for 1000. Now he is deciding that he will sell this turmeric, whatever is the wholesale price. The wholesale price is 1000. I'll sell this turmeric by after adding, let's say, rupees 200 uh, profit. So this will be the margin I will be taking. So if buying at 1000, I'll be selling at 1200. I'm buying at 800, I'll be selling at 1000. I'm buying at 700, I'll be selling at 900. So 200, everybody takes the profit per kg in the market. So I'll also take the 200 as profit anytime. Let's suppose. So he bought turmeric at 1000, and unfortunately the price went to 600. So even if he's selling at the wholesale price plus net profit margin of 200, he's having a loss. He's getting 800, he's having a loss of 200 because he bought at 1000. Fine. So price went down and he lost his 20% capital almost. And in fact, he was not able to sell at 200 margin. He has to sell at 150 margin only because the market was bearish. It was too much down. So he has to, get rid of all the stocks in the go down. So with a lesser profit margin, or you can say he has to sell at 750 and all, he has to exit. Now, if he could have taken a hedge, he might have gained instead of losing. So instead of losing, he might have gained. So how he would have done that? Very simple. He would have gone to the commodity exchange. Let's say we have MCX in India. On an MCX, you look for 1 month, 2 month, or 3 months future contract, or 6 months. You have to see how long you are capable of keeping these stocks, or how long you believe that the all stock will be sold. So let's say you believe that the stocks will be sold in next 3 months. So I would be successfully able to sell the entire stock. So if I'm able to sell in 3 months, so what I do is I choose a 3 months contract. 3 months because I can hold the future contract for 3 months. Longer the validity, I can hold it. I don't have to square it in between or roll over the contract. So I take a 3 months future contract, and obviously longer the expiry, higher the interest rate, and the higher the forward price. So let's suppose the forward price was around 1050. Let's consider. So 3 months forward price 1050. So what I'm doing is I'm selling this thing. So I'm selling it. Now, so I have a buy position already and I'm selling it. So this is a short hedge. So when you're shorting to hedge something, you're selling something to hedge something, so short hedge. I'm doing a short hedge. Now, wherever the market goes, he will be in profit. Let's suppose the market went to 600, which actually happened. So the spot price after 1 month went to 600. Now in that situation, the go down, the stock in his go down will give him loss. How much loss it will give him? 400. So 1000 minus 600. The price is 600, so 400 loss. But the future will give him profit because when market goes 600, it will be obviously future will be priced something like 610 with some interest after a month or 20. So in that situation, it will give you some profit. So let's say 1050 you sold and market went to 610. So you are making a profit of around 440. So that means you are getting around 40 rupees profit here. But this is the interest cost. But you're forgetting this one. So he's safe now. He's having that money recovered from the commodity exchange. In that situation, he need not to be hurry and sell the stock with a lesser profit margin. He can sell it for 200, keeping 200 as his profit margin. So he's getting 240 as a profit. His profit is going nowhere. The loss is covered by the stock exchange. The commodity exchange. It's very simple thing he could have done. And how much money he would have required? Hardly 5-6% margin. So let's suppose he invested 10 lakh or 100,000 into 1 million into the turmeric business. You hardly require 5 or 10% to short a future contract. You get a leverage of 10 to 20 times. If it is 5%, that means 50,000 was required additional capital to get into a hedge, and he would have saved himself. So you can use the hedging for your day-to-day business. Whatever you do, you are as an exporter, importer, or you have a currency risk, or you are a trader, stock trader. So let's take a trader's example. Let's suppose I'll give you a trader's example. Let's suppose I'm buying TCS, Tata Consultancy Services, at 1,000, and the price increased to 1,200. I'm making 200 profit, 20% profit, let's say in a month. And now that the rumors in the market telling that the price may go down. So rumors are there in the market, everybody's saying that the price will go down. So now I am skeptical. What is going to happen? So my analysis, my personal analysis interpretation says that it should go up. And the rumors in the market indicate that it will go down. Now there is a state of confusion. So if you are not able to forecast the prices, remember, if your price forecasting is poor or you're not able to forecast the prices, it's better that in that situation hold on, get into hedge. Okay, and when the price will take a direction, then we will open the hedge and we get into again naked position. So what we do here is, I'll wait. What do I wait? Let's confirm it. Let's confirm it. Let the price go down. If the market rumors are correct, then I will take decision. And actually, the rumors were correct. It went down. It went down to 1180. Now you are fearful. You may lose the profit. Now you have two options. What are the two options? Exit. Exit means you have bought at 1,000, you sell at 1180, and exit make profit of 180. Or you are a brave heart, okay, and you want to hold it. So what you do? You are actually buying here. You are selling a future contract. So you look for 1 month future contract on the exchange for TCS. Let's say which is priced 1,200, 20 rupees more. Obviously interest cost something. So I sell it. So now I have two positions. Buy TCS on 1st January. Let's say it is 10th January. I'm selling 1 month future contract of TCS on the stock exchange. Now you are not worried. Why? Because your profit of 200 is locked. No matter whatever market goes, your profit is locked. Let's suppose market goes to 1300, and the spot will give you how much? 300, from 1000 to 1300, and this will give you a loss of, the future contract will give you a loss of 100 because you sold, price went up, it's a loss, so 200 is your profit. And if price goes down, let's suppose your expectations, your rumors were right, market went to 900. So if market goes to 900, then in that situation, the shares will give you a loss of 1,000. This spot will give you a loss of 100, and this thing will give you 1,200 you short, 1,200 is sold. So price went to 900, it will give you a profit of 300. So you're getting again 200 as profit. So profit was locked. So this thing helps. So you hedge for two reasons. Either you lock the profit or you limit the loss. So how do I limit the loss? Let's suppose I have bought shares for 1,000 and the price went down to 990. I don't want to incur more losses. My analysis is that the price will go up, but suddenly it went down and I don't want to exit. I sell future. So let's say 990 future is available. So this 10 rupees loss will be the maximum loss. Wherever the market goes, so I'm buying here 1,000 spot and selling futures. No matter wherever the market goes, my maximum loss will be 10. They will be locked. So say there is no benefit of hedging. Yeah, there's no as such benefit looks, but it hedges your risk. It limits your risk. Sometimes it locks your profit. And if you open the hedge at the right time, you get great profit. Great profit. So if you open the hedge at the right time, I'll give you an example. How you get benefited if you're opening the hedge at the right time. So let's suppose you bought TCS. I'm repeating the previous example at 1,000. Price went to 1,200. And now you think the price will come down. So it came down to 1,190. You're fearful. So what you do is you sell it. You sell 1 month future. So I put a sell sign here, sell 1 month future. Now, so as we expected, the price went down and went to 800. Now what do I do is I watch, keep on watching when it will recover, when it will bottom out. So I see there was a correction of 2% or 3%. So let's say there's a correction of 3%, the price comes to 840. Bingo. Now it's giving you recovery. Now you are confident that the price will recover. Now what you do is you buy a position 1 month future contract, buy 1 month future contract and close this position. So your profit is booked. You're selling and buying at a cheaper price. So 1190 you sold, 840 you buy and close the position, the future contract. You make a profit of lump sum. How much? 250, if I'm right. So you make a profit of 250. And then if the price goes up, 350. Okay, fine. So I keep it 350. The calculation is all your part. Okay. You're good in maths. I'm not. So I am not using. Leave it here. Come on. I think I should retire. Anyways, so 350 is your profit you're getting. Now, so if the price goes up back, so you're believing that will go up. Now you're closing your 1 month future contract. So one position is closed. Now what you do is you take a naked position. You buy second month future contract here. Now why not first month? Because second month will have more validity. If you want to buy 1 month, you can buy 1 month also. Let's say buy 1 month contract. Now you have two position. What two position? Both are into long. So this is a long position at 1,000 and this is a long position at 840. You're buying it. So short position is closed and one long position is open. So now I have two long positions at 840 and 1,000. Let's suppose price goes back to 1,200. Then in that situation, the long will give you 250 profit because the stocks, this underlying asset gives you 200 profit, and the the future you bought at 840 will also give you profit of around 360. Right? So this is from spot, and this is from futures, and this was also from futures. This was from short, this is from long, and this is from long. So total is great. So you closed the hedge position here at the right time and you're entering into another long position. Now you have two long positions making good amount. I will say what happens if it goes down here. Now please, हमारी किस्मत घोड़े की लीद से नहीं लिखी, हर बार गलत होगी. ठीक है? तो if you have to be good into forecasting at least a little bit, and I'm giving you a buy at after a correction of 40 rupees on 5%. So that's a good correction. This will give you, because you did the analysis. If you are right, it's a bottom out, then it is amazing return. Fine. So if you use it good in a good way, you can make good returns. Now, advantages and disadvantages. Protection against adverse movement in the price of commodity exchange and interest rate and all. And generally, if you lack expertise in prediction, so the hedging can help you. And the against are costs, hedging cost, interest cost you pay, and criticism in hindsight. I don't understand this thing. Shareholders can hedge the risk on their own. Now, the shareholders can hedge their risk on their own, but you need a little bit of expertise, so it's not easy. And obviously, nature of the industry uh, will lead to basis risk. If they spread instead of decreasing, it may increase. In that situation, you may have losses. And many times it happens in commodity when you roll over, or many times the backwardation situation becomes contango, or contango become backwardation within the 5-6 days or a month during the period of the contract. So that will give you loss. So instead of the cost, the spread you were enjoying, uh, if the spread increases, it will become a loss for you. Let's say we took the cost of carry arbitrage model through the Excel sheet. The spread was 20. If it reduced to 0 on the date of expiry, you are getting that 20 profit. Let's suppose during the month in between, the spread increased from 20 to 40. So instead of reducing, it increases due to certain reason. Then that could be a cost. That could be a loss for you. That could be a loss if a spread increases. So there is a basis risk, spread risk with the hedging. So there it is, the basis risk. So if the spread increases, you have the problem. Now there is the problem with the perfect hedge, that is the basic risk. And there are two kinds of hedge: cross hedge and mismatching in hedging horizon. Now many times what happens is you don't get the future contract for the underlying asset. So let's say I'm looking a future contract for a small company like Gitanjali Jewelers. Quite possible I will not get the future contract. It's a small company comparatively. So there are around 1680 stocks listed on the National Stock Exchange. Out of that, hardly 200 or 300 future contracts are available. So in that situation, you have to go for a cross hedge. So you have to look for a highly correlated equity, and you can take a hedge with that future contract using the beta or the correlation. Maybe you can hedge the contract with an index. So that could be a cross hedging. So in cross hedging, there is a problem of spread. It keeps on increasing, decreasing, and you have to manage that. So learn how to do that. And mismatch in matching in a hedging horizon. Now what happens is, let's say you want the delivery on 10th and your contract gonna expire on 30th, because its future contract is fixed maturity and you need the assets on 10th only, but the delivery will be made on 30th. And in that situation, you have the mismatch of the delivery and the expiry of the contract. So that is a problem. Again, I tell you, strengthening, weakening the basis, increasing and decreasing. Now, main source of basis risk. Now, why the basis risk increases or decreases? Now, interruption in convergence, as I said, and the date of expiry, the spot and future, converges. But let's suppose just before the expiry, the company declares that we're gonna give dividend. Now, so as I told you, it can give problem. Now, change in cost of carry. Let's say rate of interest increases. Then, so it was reducing day by day, but finally, after a couple of days, it increased. So basis risk increases. Cross edge, horizon, and liquidity mismatch, as I just told you. So liquidity mismatch can also have problems. Liquidity is a big problem. Liquidity is what? Liquidity risk. You go to order a contract and there's no seller. You have already bought a contract, you want to sell and close your position, and by the time you're selling, there's no seller, and then the rate corrects, and then seller comes, and there's no use of selling. So you bought it 1,000, the rate increased to 1,200, you went to sell, and nobody was there. And after, let's say, a couple of hours, it came down to 11 and somebody came to buy. Then you're actually losing 100. There's no liquidity. There's no buyer and seller in the market. So if there is less liquidity, the spreads will be higher. Take example of real estate. Real estates are less liquid, so spreads are higher. Buying selling price, spreads are higher. If it is highly liquid, buyers are readily available, sellers are in plenty, then the spreads are less and you have lesser basis risk. Now, what is a hedge ratio or the optimal hedge ratio? Now is the time. It is 11:30 now, and I'm also pretty tired. So let's keep it for the next Saturday. Okay, and sorry, Sunday. So I have sent you the schedule for the classes, how we will cover all the topics, and next week I'll be completing my part and then coming to the next week on interest rates, and the swap and bonds pricing on will be taken by Rajat. So we will move on from hedge ratio the next week. So remember this thing, and we'll take it. It's not big deal. It's not too much to understand, but yes, if you get confused somewhere pin stuck, it may take an hour at least to complete. Otherwise, it is just a 10 minutes sharp. If you want, I can, finish it up. So if you can stress 10-15 minutes, shall I finish it up? Okay, so let's do it. A week is interested in a weekend. If a weekend, okay, no problem. I understand it's too late there, but yes, thanks. I like the spirit. Let's finish it now. Uh, what is the optimal hedge ratio? Basically, when we took the example, we simply say buy TCS and sell future. And sometimes it happens that there are lesser correlations in spot and future price. Sometimes. Normally there are 90%, 95% correlated, but sometimes it happens that the correlation is lesser, not 100%. If it's 100% great, but sometimes it is lesser. So in that situation, what happens to get the optimal hedge ratio between, uh, with a forward contract or a future contract? So we can use the formula and get the best possible, the contract, best possible number of contracts. So this number of contracts we have to hedge. So what we have to do is we have to simply take the correlation between the spot and future price, the correlation between the spot and future price, and the standard deviation of spot divided by the standard deviation of forward contract, the future price, standard deviation of future price. So we multiply the correlation with the standard deviation of future spot and divided by the standard deviation of future, we get the optimal hedge ratio for the contract. Or we can get the beta also. If we get the beta of a spot and future, we can get the optimal hedge ratio, the spot and future beta if we get it. Okay. Now we have a doubt here. Yes. Yes. I'm not able to hear who has the doubt. Gargi, okay. You have the doubt, Gargi?
Yeah, so my question was, how do we get the beta value of the spot and the future? Is it the same as the standard deviation of the spot divided by the standard deviation of the future into the correlation coefficient? Is that the value of the beta?
Yes, that is the value of the beta. Okay.
Okay, okay,
Or other
okay, okay.
or otherwise you have the beta given in the question. Okay.
Oh, okay. Well, thank you.
Now what happens is normally this is not the way to get the beta here. To get the beta, you need to divide the there's another way to get the beta is if you have the covariance, you can divide the variance, okay, and you will get the beta. So there's another way. So if you don't have the covariance, you have the correlation and you have the standard deviation, uh,
Mm-hmm.
then you get the beta. So both the way you can use covariance divided by the variance or the correlation into standard deviation of spot divided by standard deviation of power, you get the beta.
Okay, thank you.
I'll mail you a link which will explain you about calculating the variance and covariance using Excel sheet and the beta. So you can use that. Okay. So I'll link you at the end of this session. So you understand how these are calculated using Excel sheet. For now, you understand the formula for the calculator, and then the sheet will explain you what exactly the variance, covariance, and the beta. So here, to get the optimal, number of contract or compute the hedge ratio, you simply have to get the. So you have to compute the hedge ratio, the beta. So you have the correlation coefficient that is 0.9, and you have the standard deviations of the spot, so 0.20, and you have the price that is dollar, and you get the beta. Now the one problem is here is there shouldn't be a dollar sign, I guess. Normally standard deviations are in percentage. The annual standard deviation of the spot price to be this thing. So this is normally in terms of percentage. So there shouldn't be a dollar sign. So you have the correlation that is near 90%, and the standard deviation is 20% of stock, and around 1% is into the future. So you divide it, you get the optimal hedge ratio. You multiply it. Whatever comes, you have to see, you get the optimal hedge ratio. Okay. And how to get the quantity? So you need to know the contract size. You can get the quantity. I'll come to that now. So hedging with stocks index future. So broadly here you will get the optimal hedge ratio. So optimal hedge ratio is basically the beta, as I said. If you know the beta, you can figure out the number of contracts to long or short. I'll tell you what is correlation or what is variance in a nutshell, or maybe the beta, how they function. See, the normally the square root of the variance is standard deviation, and the square of standard deviation is basically the variance. Now, what is standard deviation? Standard deviation is basically the measure of volatility. Normally, we say, uh, let's suppose the average price of a stock is the average price return on a stock is 1% monthly. Let's suppose. So average price return in terms of percentage in 1% monthly. That is average, and the standard deviation is, let's say, 4%. So that stock has a volatility, high volatility. So you can say any month that can give you 4 plus 1 5% return, or any month it can give you a minus 3% return. So plus minus 4% on the average. So that is standard deviation. Okay. Now correlation is what? Correlation tells you about how correlated is the equity, which means if one stock goes up, another must also go up. One goes down, so the next one should follow it and comes down. So out of 100 times, how many times they follow each other? So if they follow 100 times, that means every day one stock goes up, another stock goes up. Every day that another stock comes down, this one comes down. But someday it doesn't happen. So let's say out of 100 times, 10 times it is not happening. So the correlation is only 90% of the time. Okay, that is correlation. Now what is beta? Beta is basically slope. Slope means like it's a multiplier. Let's take example. uh, Beta is will tell you how much it will go. Let's say there are two stocks which are 90% correlated. So that means there is a positive correlation. One goes up, another goes up. But beta will tell you by how much. Let's suppose you have an index, Nifty index or Standard Poor's 500, and you have a stock. So let's say Nifty with this stock, you get the beta. The beta is basically the market risk. We say, or the systematic risk. Now, let's say the beta is 2%. So beta of the stock is 2% with the Nifty. So if Nifty moves 1%, or the index, Nifty index in India moves 2%, or let's say Standard and Poor 500 is an index, and with that you have Xenon or the Tesla. So Tesla has a beta of 2%. So that means if the S&P 500 moves 1%, the Tesla will move 2%. So correlation will tell you they both moves together, they moves up and down together. And the beta will tell you by how much. So I walk one step and my beta is 2, so the stock will walk 2 steps. The beta is 4, the stock will move 4 steps. So I go one step back, the price will come 4 step back. So 1% down is the index, the stocks will come 4% down if the beta is 4 times. Okay, so beta is the quantum, the multiplier, the slope. Okay, now, so if you have the beta, let's say of the portfolio or the stock, and you want to hedge it with the contracts, index. So what you do is simple. You have the beta. Let's suppose I have a beta. Let's say I give you an layman example. Let's say I have a portfolio of stocks. Now let's say if I have one share, then I can look for the future contract. I can simply sell it and my position is hedged. Very simple. Little bit minor error will be there, but I'm hedged. But suppose if I have 5 stocks, then I have to hedge it separately, isn't it? Yes. So I have to hedge it separately. Now my hedging cost will be very high. Again, quite possible if one contract, or let's say one share, does not have a future contract listed on the stock exchange. So if we don't find a future contract for one stock, one company, any company, then that contract will be left naked without hedging. Now in that situation, instead of hedging one by one each and every stock separately, we take the portfolio return or the portfolio value. Okay, and we hedge the combined portfolio, okay, with the index future. Okay, so index is what? Your market. Normally S&P 500 is the market, represents the entire market. The Nifty is a broader index which represents the entire market. So you have to get the portfolio beta, okay, and you have and the portfolio value, and you can calculate the uh, number of contracts to buy or sell. So what you do is here, let's take example. You have 5 contracts and the total value of that 5 contract is, let's suppose, 10 lakh. The portfolio value is 10 lakh. So you have invested 10 lakh into the market, okay, to get the, you have 10 lakh to invest into the market. So you invested 1 million, and now you want to hedge it. Now you figured out the beta using the formula. You have the formula, two formula, the correlation into the standard deviation of this divided by this, you get the beta. Or if you have the covariance divided by the variance, you get the beta. Or you can get the slope formula done on an Excel sheet and you get the beta. of the portfolio. I can show you how you get it. So let's go to one of the slides. So let me get the beta calculation. So get the portfolio value. Let's say I have two companies with me, Idea and Sun Pharma, and Nifty value. So I take the daily percentage change of Nifty. You can take monthly, you can take weekly. So if you want to calculate weekly beta, monthly beta, daily beta, your wish. Normally I take the daily to get the beta, otherwise return I take the monthly or weekly. Anyway, so I take the daily return for the daily beta, or you can say the slope. Slope is not like daily, but yes, it's a multiplier. So normally I take daily price. If you want to take weekly, that will also work well, no problem. Or monthly will also work well. But then the sample size should be at least 30. Okay, you will get a good t-test and result will be very good. So I take the percentage return on the idea one day change. So it went from 202 to 198. So one day change was minus 1.73%. So what I did was I put a simple formula: selling price minus buying price divided by the buying price. So previous day price, today's price. So I reduce today's price minus previous day's price divided by the previous day's price. I get the daily return. So I put that return here, Sun Pharma and Idea, and the return of Nifty. Now what I do is I am creating the portfolio. So how do I calculate the portfolio? I multiply the return by the weightage. Now Idea I am giving a 40% weight, and Sun Pharma I am giving 60% weight. Weight means, let's say I have 1 lakh, so I'm investing 40,000 into Sun Pharma and 60,000 into, sorry, 40,000 to Idea and 60,000 into Sun Pharma. So which my return will be also affected. So whatever return I am getting in Idea, I'll multiplying that by 0.40 the weightage, and from the Sun Pharma I multiplied by 60. So you can see here the formula. So I get the portfolio return, daily portfolio return, and I have the daily Nifty return. Now what I can do is I can simply put the slope formula and I'll get the beta. I'll get the beta for Idea, I'll get the beta for Sun Pharma, and give beta the portfolio. So what I do is I have to take the X and Y value. So Y is normally your portfolio and X is your Nifty index. So normally the Nifty is on x-axis and the y-axis is your portfolio or the stock. You get the beta. So beta of the portfolio is 9.2, where the Sun Pharma beta is 1 and the Idea beta is 0.8. So you can see if the Nifty moves 1%, the portfolio will give you a return of 0.92. So it will move only 0.92, less than a percent. So 0.92%. Okay. So if Nifty moves 2%, you multiply this with 0.92, the stock will move like that. So what happens in that situation if the beta is not 1? Then if you buy the contracts, you are not properly hedged. I'm sorry. If the beta is 1, you can buy the equal number of contracts, you're perfectly hedged. If the beta is not 1, but the number of contracts, if you're not multiplying with the beta, you won't get the proper result. Okay, it's too much. I'll give you an example that will give you a better idea. Let's suppose I have a beta of 1 of the portfolio. I've invested 10 lakh. Future contract prices, let's suppose Nifty is 8,000. So Nifty's price I'm taking, index or the Standard Poor, whatever it is running, multiplied by the lot size. Let's suppose I have a lot size of 50. Now how much it will give me? Can anybody give me a calculation then quickly? What will be the value? So I think it will come in something point. I'll keep it round figure. So let's say I keep the contract value, the Nifty value to 5,000. Okay, so that I get into a round figure for the sake of easy calculation. So how much it will come? How many contracts I need to buy? So Nifty is 5,000 and the lot size, contract size is 50. So it's come to 2.5 lakh and 10 lakh is invested. So 4 contracts. Am I correct? Calculations are right. Now, so let's suppose this moves 1%. Portfolio value moves 1% because the price moved. So if it is moving 1% and you are doing a short contract, you're selling 4 contracts. So you're selling 4 contracts of Nifty, selling Nifty. So 4 contracts you're selling of Nifty. So what happens if the beta is 1? Now nothing. So if the contract moves, the portfolio increases 10%. So that means 1 lakh. Obviously, you have 500,000 into 50 into 4 contracts, which is equal to 10 lakh. Obviously, this will give you again same return. So if this gives you a profit of 1 lakh or 100,000, this will give you a loss of 100,000. Both are equal, isn't it? Is so if the beta is 1. Now suppose that the beta is 2. In that situation, what will happen is, suppose you are taking 4 contracts. Suppose the beta is 2. You are not taking 8, 6, 7 or 9 contracts like that. Not as per the beta. In that situation, what will happen is, if Nifty moves 1, let's say 10%. So you get, you're selling, you're losing 10 lakh, sorry 1 lakh, and the beta is double. So in that situation, your shares will move double. Instead of 10%, it will move 20%. So this will give you a return of 200,000. So you are into surplus, isn't it? Is but just think, if the Nifty goes 1% down, it will give you 100,000 as a profit, and this will give you a loss of 200,000. So you are not perfectly hedged. Now in that situation, what you do is simply you multiply it with the beta. So if the beta is 2, now the contract side becomes double. So it is almost 8 contract you are taking. So now you are perfectly hedged. So if the beta is 2, so that means if Nifty moves 10% down, obviously you have a loss of how much? 2 lakh, because you have now 8 contracts, and your stocks will move to 20% now, the portfolio. So that will be 2 lakh. So both are perfectly hedged. Am I okay? Shall I repeat? So beta is the slope, quantum of movement, multiplier. Are we okay, or shall I elaborate it? Hello, ding dong. Shall I explain it further, or shall I? It's done. You got it. Fine. Savik says is good. Gargi, use the chat box. Okay. She wants to talk. Yes, please tell me. Yes.
Sorry, I don't see the chat box, so I couldn't send you a message. I'm good.
You're good. Okay, great. So let's move on. Now, adjusting the portfolio beta. Now, let's suppose I want to reduce the systematic risk, or I want to increase the systematic risk. Okay, that means portfolio beta. I want to increase or reduce. So let's suppose in previous example, my beta was 2. No problem. So my beta is 2 in the previous example, and the amount I invested was 1 million around, and the contract size was 5,000 into, let's say, 50. So 5,000 was the Nifty index spot price or the future contract price, and 50 was the lot size. So in that situation, I need to buy 8 contracts. Now let's suppose I reduce the beta. reduce the beta to 1. In that situation, how much I need to buy or sell? I need to sell 4. So the minus sign will represent here you have to sell. And if the beta is already low and I want to increase it, I increase to 4, then this becomes a plus. So in that situation, I need to buy the contracts to hedge. As simple as that. So if I want to adjust the portfolio beta, I want to reduce this. Let's say I want to reduce this to 0, close to 0. Then situation I have a lot of more contract sold. This will come to minus sign, minus 2, 0 minus 2. So it's so in that situation what happens is if you have to reduce the beta, okay, so this is the targeted beta, you put it and minus the current beta and you get the adjusted portfolio beta. So this normally we do to increase the systematic or systematic risk or to reduce it. Let's say I want to go for a higher risk, high return strategy to increase the beta. I want to go for a lower risk and lower return. I reduce the beta. So I reduce the beta. So in that situation, what I have to do is I have to sell extra contracts. Simple as that. See, I have sent you some notes. Just refer to those from another mail ID, and that will help you a lot. Now, what do you mean by rolling the hedge? Now, rolling the hedge means normally your contract gets expired every month. So if you want to roll over, you can roll over, but rollover has risk, then that has cost associated to it. Now what it is, let's say I am buying 1 month future contract on 1st January and they're going to expire on 28th of January, and I bought at 1000 and now it is at 900 and I have to sell it. If I don't sell it, exchange will sell it on behalf of me, so I have to close it. Now if I want to roll over, so I will be carrying the loss. So if I want to roll over, the next month contract may be priced at 960. Now in this situation, I'm losing here 100 rupees. And then I have to put in 60 rupees more to buy this contract. So in that situation, I have a cost associated to this thing. So rollover has this cost associated to this thing. And one more thing, from my practical, personal experience, if you are losing a trade, if you're having losses in your trade and at the time of expiry you are actually losing, close your position, don't roll over it. You should only roll over when you think the price will bottom up, it will recover and it will become bullish. So let's say previously you were bullish and then you enter the position. You never know what will happen. Let's say if you roll over here and after some time it goes to 900 maybe or below that, let's say 840. So in that situation you have further loss from 960 to 840. It's a more loss and price was continuously going down, so it's a bearish, it's a bear run. So in bear run you should not roll over. Okay, so you should wait, and when the price will show a recovery, let's say it goes to back again to let's say 900 or something like that, or maybe 880, then you buy. So save 20 rupees, and when price will go up you buy, then you make money. And you should roll over only when you are into profit. So let's say you are buying at 1000 and at the end of month is 1200 and the second month contract is, let's say, even it is 1210 or 1220, you can roll over because 200 you are making profit and now that you're putting 10 rupees extra, not an issue. Fine. Jaideep is not participating. No worries, Jaideep. If you have any issues, you can put an email also. If you have any doubt later on while solving questions, you can go through the videos also in your account. And I'm recording all this. I'll make it available within 2 days. You can access it. Fine. So now we have questions, and it's 12 questions I'll take next week. Okay. So good night, and we'll catch you next Sunday. Okay. Till then, take care. Enjoy. Bye bye. Good night. Yes, good night. You have any questions? You're welcome. Take care then. Can you send a zip file instead of a RAR? I can send you a link to unzip the RAR. Okay, you can download the software. It will be better because zip file is a big one, and I have to unzip it and then zip it and then resend. It will take a long, too much time. So I'll send you the software link, which you can use to unzip the RAR file. You're welcome. Take care. Bye bye. Take care, Jaideep ji. I'll see you next time on time. And go through the videos and do let me know if you have any doubt. Okay. Take care. Bye bye.